In this presentation, I'm going to discuss the lessons learned during the 2008 financial crisis. By the end of my presentation, you should be able to understand that Lesson 1, time is not different and it does not change facts or situations. Advanced technology did not mitigate the 2008 financial crisis. Lesson 2, we need to recognize and avoid adverse selection and information asymmetries in investments. Lesson 3, we need to understand the importance of an empowered, independent, and integrated risk management function. This did not occur with firms and banks involved in the 2008 financial crisis. These firms and banks did not have a solid risk management function. Lesson 4. Coordination among regulators is critical and must be enforced. And finally, Lesson 5. Too big to fail does not hold true. Many large organizations like Lehman Brothers failed. The American Insurance Group had to be bailed out along with many other firms. Here is a quote that I believe puts the 2008 financial crisis in perspective. Rufus Fears from the University of Oklahoma said it well. We do not learn from history, and the consequences of this failure are tragic. Here are a few statistics from the 2008 financial crisis that are staggering. The 2008 bailout cost taxpayers over $700 billion. 8.8 million people lost their jobs. 8 million home foreclosures occurred. And lastly, $19.2 trillion in household wealth was lost. Here are some pertinent items from the 2007 to 2008 financial crisis timeline. So in June 2006, housing prices peaked. Everyone started getting into the subprime mortgage lending spree. However, in April 2007, subprime mortgage lender New Century files for bankruptcy. In July 2007, Bear Stearns disclosed that the two subprime hedge funds had lost nearly all of their value amid a rapid decline in the market for subprime mortgages. On August 1, 2007, investors in the two funds took action against Bear Stearns and its top board and risk management managers and officers. In August 2007, American Home Mortgage also filed for bankruptcy. American Home Mortgage Investment Corporation was the 10th largest retail mortgage lender in the United States and was structured as a real estate investment trust. On March 11, 2008, Moody downgraded Bear Stearns to B and C levels. These two events triggered a bank run. Bear's clients pulled out their deposits and investments. By March 13, 2008, Bear Stearns only had $2 billion left in cash. Bear Stearns collapses and was sold to J.P. Morgan Chase. On March 16, 2008, Bear Stearns, the 85-year-old investment bank, narrowly avoided bankruptcy by its sale to J.P. Morgan Chase and Company at the shockingly low price of $2 per share. With a stock market capitalization of $20 billion in early 2007, Bear Stearns seemed to be riding high until its problems with the subprime hedge funds and other related investments occurred. On September 15, 2008, investment banking giant Lehman Brothers filed for bankruptcy after 158 years in business. The firm, whose fate was in doubt for over a week, made its intentions known shortly after midnight as talks aimed at saving the 158-year-old firm failed. Lehman shares lost 94% of their value the Friday before they filed for bankruptcy. Lehman's dramatic collapse concluded what proved to be a long 3 days for top Wall Street executives and regulators, who held marathon talks to try to develop a rescue plan for the investment bank. Over the past 6 months, the firm had lost close to $7 billion because of bad bets on both the housing and commercial real estate markets. Many regulators hoped someone would buy it out, most notably the British bank Barclays or Bank of America. Instead, both suitors pulled out, with Bank of America announcing it had bought Merrill for $50 billion in stock. On September 16, 2008, the American Insurance Group's inability to post required collateral against credit default swaps it had written drove AIG into insolvency. Also, on this date, the Federal Reserve provided an $85 billion 2-year loan to the AIG to prevent its bankruptcy and further stress on the global economy. I interviewed Joseph Jacobs, a former insurance regulator of the American Insurance Group, and he made a comment that AIG and other lenders were unethical in how they pursued and made loans. Now I'll go into a recap of some of the early warning signs of the 2008 financial crisis. First is Bear Stearns. For Bear Stearns, while there were many signals in the market before this event, The downfall of Bear Stearns marked the beginning of the oncoming financial crisis that would shake the financial system worldwide and result in a global recession. In 365 days, Bear Stearns stock dropped from $159 per share to $2 per share, with about half of the loss occurring within a few weeks. Next is Lehman Brothers. Despite warning signs, Lehman Brothers increased its subprime mortgage and real estate holding even after prices declined. They held $111 billion in real estate assets, more than double their assets in the previous year. Next, the American Insurance Group. In March 2008, United States regulators sent AIG a letter stating lack of transparency and ability to oversee its financial products. By September 15, 2008, AIG's investments and credit defaults had driven the United States into bankruptcy. Also, earlier on September 15th, the Dow Jones Industrial Average suffered a painful sell-off, falling more than 500 points, its worst decline in more than 7 years. Lastly, Countrywide Financial. In 2008, Countrywide Financial became overextended in subprime loans. It was the largest mortgage lender. The CEO disregarded credit quality of underlying mortgages and was forced to sell Countrywide Financial to Bank of America at a very low price. The first lesson of the financial crisis is that time is not different. Preventative measures should have been taken. One should suspect that a bubble is about to burst when there are new talks about paradigms. An argument that this time is different is not valid. Regulators and other industry leaders need to maintain discipline to run the improbable but not impossible or implausible scenarios to make sure firms survive the worst case scenarios. The second lesson is that we should recognize and avoid adverse selection and information asymmetries. There are preventative measures that can be taken. Avoid taking risks that your firm does not understand. Seek out expert help if you do not understand the risks. Run models and risk factors related to derivative pricing. Run simulations that mirror true risk return scenarios. Understand the new pricing factors such as credit valuation and adjustments that go into fair valuation. And lastly, avoid complicated securities and derivative products. The third lesson is the importance of an empowered, independent, and integrated risk management function. It is important that the risk management be effective. Risk management must be worth the investment versus the cost of failure of bankruptcy. Risk management should promote positive availability of the capital, and it must control yield to bonus mentality of management. The fourth lesson of the financial crisis is that coordination among regulators is critical. Regulation must be effective. Regulation was not effective prior to the financial crisis, but after September 15th, regulators bonded together to avoid global financial disaster. The American Insurance Group felt that they were above regulation. They didn't think that they needed to obey regulators. Also, the AIG was allowed to utilize some creative accounting by their own firm. Additionally, there was some complicity a part of the federal government, as the SEC valued the AIG investments and the SEC did not want to address the AIG valuation questions posed by the insurance regulators. The final lesson of the financial crisis is that too big to fail does not hold true. Too big to fail became the motto of the financial crisis. This phrase means that some institutions are so large and critical to the economy that they cannot be allowed to fail, no matter what the cost to the American taxpayer. This was the case in the 2008 financial crisis when investment banks like JP Morgan Chase, Citigroup, and the three large automotive companies of General Motors, Ford, and Chrysler were bailed out by the U.S. government. In addition, the U.S. government provided more than $182 billion to the American Insurance Group in bailout funding. Now I'll talk about some failed risk management examples. The American Insurance Group CEO at a congressional hearing stated on March 27, 2009, "We had risk management practices in place. They are generally not allowed to go into the financial products of the business." The Office of Thrift Supervision was reported that the AIG financial products were allowed to limit its controls. Now I'll talk about some of the new legislation that came out of the financial crisis. The Dodd-Frank Act of 2010 reorganized the financial regulatory system. It eliminated the Office of Thrift Supervision as they failed as a regulator to the American Insurance Group. It changed responsibilities for the FDIC and created the Financial Protection Bureau. There's also the Emergency Stabilization Act of 2008. It provided $700 billion to purchase troubled assets from the AIG, JP Morgan Chase, Citigroup, GM, Ford, Bank of America, and Chrysler. Thanks for listening and contact me if you have any questions.